please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning. Now, welcome to Bazaar Morning Call. I'm Lata, and now Sonia and Anuj are with me. Well, it's difficult to guess how the markets are going to react. There has been so much of a whipsaw movement. It's possible that yesterday, since we reacted so violently to the Dow futures falling by 500 points, today there's some bit of recovery coming. I guess the Deepak Kochhar statements are also going to be a bit of a sucker, a bit of a help to ICICI stock, and some clarifications on provisioning could also help banking stocks, for the simple reason that there is a credit policy and you could see some improvement in bond prices. So the chances are, at least for me, Anuj, that there are positives on the horizon for us.
Hi, good morning, Lata. Good morning, Anuj. You know, we were just discussing yesterday on Closing Bell as to how you don't know how you're going to wake up and what tweet is going to come from Donald Trump and move the market either way. But thankfully, nothing has happened overnight. There was a huge recovery that we saw from the Dow. Anuj, morning. What are you expecting today? I mean, we've been whipsawed either way the last few days. You think today there's a short covering bounce?
Yeah, Sonia, morning. You remember we were discussing this as well yesterday, that there could be a powerful short covering bounce at any point, but we don't know when that would come and what would that trigger be. There was an 800-point intraday recovery in the Dow, and we fell yesterday. Look, the scared bear is the biggest bull, right? Today, the bear would be scared with the gap up. So, power of short covering will be on display. Now, per SGX, we are likely to open right at yesterday's high. So, it's not going to scare the strong bear, but obviously it's going to scare the weak bear, those who would have shorted the breakdown yesterday. They would be taken to cleaners first thing in the morning. After that, what do you do? I think after a 180, 170 point gap up, do you buy? I don't know. Maybe, you know, you have to then wait and see if that first hour strength is sustaining. You know, if we are going to have a trend day, in that case, you will want to see the first hour high, 9 to 10. And then see if that is sustaining between 10 to 11 or, you know, not. If it's breached, then obviously there's more short covering. If not, then the adventurous shorts would again try their luck, because our market is inherently still weak. This FI shorting is still continuing, which is interesting. Even yesterday, they added 25,000 shorts. There was some long addition as well. And the long exposure is down to 18%. So it's entirely possible that we have a bit of a short covering bounce. Today's also weekly options expiry on Bank Nifty. And you have a policy, and you have a lot of shorts in the private bank. So I think the Bank Nifty could see a big amount of short covering. We closed at 24,130. Yesterday's high was 24,666. Possible to have a 500-point rally on the Bank Nifty? We could, but let's see. That would be the mark for me to watch out for in today's trade. But all of this is reiterating one more point, that this year is going to be so volatile. And, you know, you're better off looking at high quality stocks and buying them on weakness, because this year is about, you know, correcting your portfolio. Last year spoiled you in terms of, you know, yesterday, for example, HEG, Graphite, you remember the kind of fall that these stocks had. So this year is going to be a lot more about focus on portfolio, good stocks, buying on weekdays. And as far as the intraday trading is concerned, let us see if the first hour high is sustained or not. That's something to watch out for.
Okay, every day is a new day these days, right? You can't tell which way the trend moves. But we have the monetary policy today, and it seems like we're going to begin the new financial year with a status quo as far as rates are concerned. But more importantly will be the tone of the RBI on growth as well as on inflation.
Yeah, I would think so. You know, there is so much of whipsaw actually in the bond markets as well, Anuj. So I think now both the markets want a status quo policy and less drama, and I think that's what they will get. But people will watch out for whether there will be any hints to a hike any time in 2018. That's really what the market will look for cues. And if the growth figure, which, well, more than the growth, the inflation figure at the moment, the forecast is 5.1 to 5.6 for the first half, and for the second half, 4.5 to 4.6. So the question the market will wonder is whether that is going to be raised or lowered. One doesn't know what was the, you know, dollar, the oil price that was factored into this forecast. If that forecast was factored in on a $55 or a $60 oil price, then there is reason to move this higher. But food prices have been falling, so that could cancel. What is the MSP calculation that the RBI would work with? All those would be imponderables. So if they do anything to the inflation target, then that would definitely move the market either way, depending on how they move it.
Yeah.
Likewise, growth. Last time the Reserve Bank was very kind to growth. There was a statement saying that a nascent recovery needs to be sustained. Now, when they gave the growth forecast of 7.2, were they aware and did they factor in the new NPA rules? Because the new NPA rules were announced 5 days after the policy. So did the RBI factor that in? My sense is they would have. But if they, for any reason, lower the growth forecast, then again that will be seen as very dovish. I don't think they will cut, hike rates if they are lowering the growth forecast. So basically, you just have to look at the inflation and growth forecast. Any change in that will be seminal. And of course, one last point, if they increase the amount of bonds that foreigners can buy, the bond markets will be very happy. So I think the bond markets will go into the policy with actually on the front foot.
I also think, I don't know about you, but I also think that some tough questions on governance, on supervision of the banks, monitoring of the systems could be posed to Governor Urjit Patel, and maybe that may also, be the highlight.
I don't think those will be market moving, but those will definitely be the highlights when he answers them.
Okay, if he answers them, that is, right? Let's take a look at what our wise experts have to say as we head into trade this morning. Rhythm Desai of Morgan Stanley believes the heightened volatility and sharp drawdown in the first quarter of 2018 may be followed by a quieter market in the second quarter as the market awaits confirmation of a new growth cycle. Morgan Stanley thinks macros and earnings will be the central driver for stock prices along with global developments in the second quarter of of 2018. Rhythm also believes that the market may react to Karnataka elections, among other things.
Okay, we have some more equity opinion. This one is from Indrajit Bhatia of Macquarie. Indrajit says the case for domestic cyclicals has strengthened with prospects of a global trade war. He says other factors helping are a sharp pickup in road awards, forecast for normal monsoon, auto sales and fiscal deficit and control. Macquarie's top picks include domestic cyclicals like L&T, ICICI Bank, Maruti Sri Cement and NCC. He says they would generally stay away from mid-caps due to valuation discomfort.
Okay, let's get you some money market views. The home currency closed lower against the dollar yesterday, so 65.15 is where we're at now. Mohan Shenoy of Kotak Mahindra Bank says global equities saw a sell-off after China imposed tariffs on US goods, resulting in a risk-off scenario and downward pressure on the dollar. However, he says the dollar recouped losses after strong US data and reassessment of trade war impact by the market. He says the rupee remains in a range with exporter hedging offset by weakness in equity markets. He expects the dollar INR to trade in a range of 64.90 to 65.20 for the day.
Mohan Shenoy also says the government securities market was positive due to a change in the regulation on MTM provisioning and the forecast for a normal monsoon, leading to higher traded volumes and position building yesterday. He says the market expects status quo in the MPC review coming up later today with a cautious commentary. He expects a 10-year benchmark bond yield to trade in a range of 7.26 to 7.34 for the day.
Okay, US market, well, intraday recovery of more than 800 points on Dow. Here's Nigel with the world view.
Well, that's right, Anuj. More than 700 points is the recovery that we saw on the Dow. All the three indices, they ended with sharp gains in yesterday's trading session. Well, the Vol index as well was in focus. At one point of time, it went all the way to around 24. It ended closer towards that 20-odd mark. Well, the big gainers yesterday were Microsoft as well as IBM for the Dow. Both of them contributed substantially. And the S&P 500, well, it closed above the 200 DMA mark. And in fact, the gains on the S&P 500 were led by consumer stocks as well in yesterday's trading session. Well, three factors really played out. All eyes on President Trump's Twitter account. Well, yesterday, he didn't really bash Amazon or anything. He said, well, they're not in a trade war with China. That war was lost long time ago. And that's why, in fact, the U.S. trade deficit is already $500 billion. The second one was really a statement coming in from U.S. Commerce Secretary Wilbur Ross. He said that, in fact, the Chinese tariffs that were imposed, that amounts to only around 0.3% of the GDP. So that's what traders liked yesterday. And finally, in fact, there were reports that indicated that President Trump may soften its stance, in fact, in terms of NAFTA negotiations that are ongoing. So all those three factors, they contributed, and that's why, in fact, we did see the US markets did end higher. Well, the economic data, the private jobs that were added yesterday, that came in at around 241,000, sharply higher in comparison to around the 205,000 that the street was working with. Well, the services PMI data as well as the non-manufacturing PMI data as well, they missed estimates a tad bit. So the US economic data more or less mixed. In terms of the European markets, well, they came off the low point of the day. The FTSE managed to end mildly in the green. And well, this morning, the Asian markets, the Nikkei as well as the Kospi, both of them trading with good gains. And in fact, we won't have any cues coming in from the other markets as the Chinese, the Hong Kong, as well as the Taiwanese index. All of them are closed. The SGX Nifty is suggesting we're likely to open up at yesterday's high point of the day, a gain of around 160 points. Back to you all.
Oh, yes, that will be interesting. Don't have too many Asian cues today, of course, but SGX Nifty is indicating a gap up. Richard Harris is with us, Chief Executive at Port Shelter Investment Management. Richard, good morning. What have you made of this big volatility in the equity markets?
Well, we've all been saying the markets would be quite a lot more volatile from now on, and here it is, so we shouldn't be terribly surprised. I mean, I think what people are also getting slightly confused over is so many market commentators are looking at points. Well, if you're looking at 800 points and the index is at 16,000, it's very different from looking at 800 points with the index at 24,000. So the actual percentage moves aren't extravagant. You know, we're talking maybe 1% down, 1% up, that kind of thing. You know, if the markets are really volatile, if you remember the good old days, you're talking, you know, maybe 3 or 4% in either direction. So I wouldn't say that this is particularly volatile, but I think that we are getting to a stage where volatility is becoming more normalized.
Okay. Richard, hi, good morning. The problem is with the US-China trade war is that nobody knows how this is going to end, and that creates a lot more volatility. But as equity investors sitting so far away in India, how do you think we should approach all of this?
Well, I think obviously the big issue is that Trump is quite unpredictable, and he likes it that way. You know, we've seen a lot of trash talk on trade, as I call Trump's trade trash talk. That's been continuing because, of course, what he would rather do is talk trashy and end up with not having to do very much. And that's almost what Larry Kudlow was sort of saying last night as well. However, I think the Americans are determined to go ahead if they do it, and the Chinese are determined to do a tit-for-tat retaliation. I see it more as a skirmish than a war because, you know, both sides depend on each other quite a lot. But I think what the Americans are looking at doing is forcing China to open its market because the big issue is not exports, it's actually imports of other nations' goods into China.
Okay, well, Richard, for whatever reason, we are seeing all equity markets getting kind of not able to cross earlier highs. So are you a buyer in equities every time you get one of these trade news or, you know, FANG company news? Which are your favorite markets?
Well, I think somebody is because, you know, we saw the market down quite a lot last night and recover. And it's been a little bit complicated by various public holidays too. But it looks as if that there is some sort of consolidation going on at this phase. Often these consolidation periods can last a while. You know, the last big one was from 2014 to 2016 when the market hardly moved. So I think we are in a consolidation phase. I am still basically a holder of equities, maybe a buyer on dips, because I think that the underlying economics looks still, it's still a Goldilocks scenario in historical terms. So I think the markets will react to that eventually.
And what is your pecking order as far as the market investments are concerned for the rest of the year? Which market looks the most attractive to you?
Well, I would say on a longer-term view, I'm still favouring sort of the later cycle markets, you know, Europe, the European markets coming through, and the emerging markets coming through. Now, I have a slight question mark over China, because any kind of trade skirmish will be worse for China. China will come off worse, and that may well impact the equity markets looking further out. But In a general terms, I think India will still look fine, obviously subject to volatility, and most of the other emerging markets, but question mark over China.
Okay. Well, that's good to hear. On that positive note, Richard Harris, pleasure speaking with you. Thank you very much. Well, as Richard points out, at every blow, there are buyers at lower levels, but we'll have to wait and see how things pan out here on the trade front. But today, all eyes in India, of course, are going to be on the Reserve Bank's monetary policy. Jahangir Aziz of JP Morgan joins us on the phone line all the way from the United States. Good evening to you, Jahangir. Thank you very much for joining us. The bond markets have already seesawed a lot in the first quarter of this year. What do you expect? What will you look out for from the monetary policy statement?
Well, I mean, clearly it's the language that will matter. Whether they will continue with the accommodation or they will say that the period of accommodation is over. Like everyone else, we are not really expecting any actual action to be taken place. So the baseline is that they will keep to the keep the repo rate at 6. Having that being said, given the fact that we have seen food inflation undershoot and you are going to see relief coming from that front in the next couple of months, seemingly there is no urgency. But at the same time, if you look at the medium term, which is what this monetary policy should be telling us about the year-ahead forecast, I haven't seen any forecast that says that inflation 12 months ahead will be below 4%. In fact, Reserve Bank's own forecast had been about 4.5%, and since then, almost every development suggests that it is probably going to be even higher. You have the MSP coming up soon. Oil prices that they had used in their previous forecasts, currently oil prices are significantly higher than that. And add to that the government, for the second year in a row, will have pretty material fiscal stimulus on the ground. So chances are that they're probably going to end up with a but an inflation target which will be higher than 4%, probably even higher than 4.5%.
Okay, so that's on inflation, but what about on growth, Jahangir? Do you get a sense that the RBI could lower its growth forecast?
I mean, you have seen at least the high-frequency indicators in the first quarter of this year is second quarter of calendar year, first quarter of the fiscal year, is showing signs of slowing down compared to the fourth quarter of the last fiscal year. And that obviously is something that is somewhat worrisome, given the fact that global trends are suggesting that things should have improved much more than what India has seen. But my guess is that given you have 0.3, 0.4 percentage points of GDP of fiscal stimulus in this budget, it is hard to see the growth forecast for this year will actually be lower with that kind of a fiscal stimulus in play.
Okay. Jahangir, do you expect that they will ease the NPA rules?
They have already eased the MTM rules.
They've eased the MTM rules, but there were NPA rules as well, which were stricter. Is that something that?
I'm sort of not exactly sure what the RBI is trying to do at this point in time. I mean, it has actually extended more regulatory forbearance than it should have. The banks get hit on their balance sheet because of fiscal profligacy. The RBI goes and accommodates that by allowing them, by easing the MTM rules. So at this point in time, I'm not exactly sure what is RBI trying to do, given that it has significant amount of NPL problems at the same time. Extending regulatory forbearance isn't really the best way of trying to achieve inflation targeting, improving monetary transmission, etc., that the RBI keeps telling us about.
So in the last policy, Jahangir, the RBI was hawkish because of, inflation quickening, and also the government had relaxed their budget deficit goals. Do you think this time around the RBI will be as hawkish or not?
My guess is that, this is going to be sort of a test of an inflation targeting framework. That here is a situation where current inflation is actually lower than what people had expected. The food inflation has actually undershot most of our expectations. You are likely to see that go through in the next couple of months. But inflation targeting as a framework is forward-looking. As I said, medium term, 12 months ahead, it is very unlikely that you can foresee inflation anywhere close to 4%, given the fact that you have all these variables. You have much higher oil prices than what the RBI had used in its previous forecast. You have the MSP coming up, and you have, as I said, 0.3, 0.4 percentage points of fiscal stimulus. So if you're a true inflation targeter, you're looking ahead 12 months ahead and you're saying, look, there is no feasible way in which I can see inflation actually below 4%, then you would become uncomfortable. So toning down the language, I was actually thinking that maybe the risk is that they might actually go the other direction. That
they should be hawkish. Okay. All right.
They should be hawkish.
All right.
If they're true to the inflation targeting. So that's a separate issue altogether.
All right. Well, then that's important. A lot of people could expect them to be true to that. Let's wait and see. Thank you very much, Jahangir Aziz, for joining us. A very good chance that they sound hawkish, but let's wait and see.
Okay, we'll take a short break on that note, but plenty of stocks to discuss on the other side. CNBC TV18's top 10 list of stocks to watch for the day.